The difference between a first lien HELOC or first position home equity line of credit and a second lien HELOC or a second position line of credit is very simple. A second position or second lien HELOC is what you're going to find through most banks and lenders that offer home equity lines of credit. And what they're looking at is they're looking for available equity that you already have in your mortgage payoff. So let's say you have a $300,000 mortgage. Typically, you'd have to have at least $100,000 with most home equity line of credit lenders. Some may be a little bit less, some a little bit more, but let's call it 100,000 of available equity to be able to get a line of credit against that equity. So the mortgage you have has a first position or first lien, which means that if you have a balance, you can't sell the property without paying off the balance of the mortgage. So the mortgage lender has a first position on the balance that's due. If you're going for a line of credit, well, they give you a line of credit on a second lien HELOC or second position against the value of the equity. So it's a separate line of credit against that equity. All right. And so that's a second lien, which means that the mortgage lender has a first and your HELOC has a second. Now, that is a good tool to use if you're looking to practice velocity banking. However, it does take responsibility to be able to move money in and move money out of your line of credit. You have to be more disciplined in your timing to manage, and yet you have to make sure that you're using it very responsibly and not overusing it or abusing it in terms of the balance, so that your home equity line of credit remains open and you don't have any trouble with them closing it early because you've over leveraged it and you're sitting on a high balance and puts it at risk. So a home equity line of credit in the second position is a very powerful tool and can be used to pay off debt. It can be used to invest in your business. It could be used for many different reasons, however you want to use it. A first position or first lien HELOC is completely different. This can be literally used to purchase a brand new property. So if you want to buy a new property, whether it's your primary resident or an investment property, you can use a first lien HELOC to do that. Or if you already own a property with equity, instead of doing a second lien, you can do a first lien. The difference is that the first lien would refinance the entire property and all of it would go into that HELOC, which would be a first position filing. So there is no second, only one position, one line of credit, no more mortgage. All of it goes into the HELOC. The balance of the mortgage becomes a balance on the HELOC. Now, with that said, every monthly payment you make moving forward towards the balance on your HELOC or your mortgage will immediately become available equity. The next day, within 24 hours, you can literally access that equity. If I make a $3,000 payment today, I'll have $3,000 available equity I can leverage from my line of credit tomorrow. So it's instant access to my equity. I don't have to worry about paying off the mortgage for 5 or 10 years to get to 100,000 or whatever the amount is so that I can apply and get approved for another second position HELOC. Every monthly payment I make unlocks that equity. So again, I can buy a brand new property with this and I can start unlocking equity immediately, or I can refi an existing property into a first lien HELOC and have access to the available equity. Plus, as I make my monthly payments, continue to access more and more equity. Okay, so that's number one. Number two, with the first lien HELOC, they're going to provide you with a checking account that's attached to the HELOC. Now, that checking account is FDIC insured, so it's a depository checking account where you can store your money and you'll have a debit card, a checkbook, like any other checking account. But with this checking account, it's attached to your HELOC, to your first lien HELOC. So instead of having to put money into the HELOC, if you're practicing velocity banking and having to move money out of the HELOC to pay for bills and expenses, you let your money sit in the checkbook. That's it, inside the checking account. And the bank or the lender does a daily sweep to see what do you have it sitting in your checking account. So if you're storing your income and your cash flow in the checking account, they do a daily sweep and they treat it as if you made a payment into your HELOC. So you no longer have to move money in and out of the HELOC. You just let it sit in the checking account, but you get the same benefit and treatment as if as if you move the money into the HELOC by transferring it in and taking it out to make payments on bills and expenses. Remember, the benefit of using a line of credit is that if you let your income and cash flow sit in that line of credit, it reduces the average daily balance, which, when the interest is calculated, reduces how much interest you pay. As a result, it frees up cash flow so you can pay off your debt faster. So with a first lien HELOC, it kind of puts it on autopilot because you don't have to worry about moving money in and moving money out. They do that for you automatically on a daily sweep. Okay, so that's advantage number 2. So with the first lien HELOC now, I am unlocking equity. I have a daily sweep with a checkbook. I can spend money directly from the line of credit with the debit card and checkbook, and my income and cash flow directly affects the balance, which effectively reduces the interest rate on the line of credit. So I pay less interest and I free up more cash flow. Now, again, this doesn't work in every instance. Some of the banks that I would recommend in over 20 years do not have one default. And that's because they're very careful to make sure that you're the right fit for this first lien HELOC. Even though you might qualify for it, it might not be the best fit if you don't have enough cash flow to really reduce that average daily balance throughout the month. And so just because you qualify doesn't mean it's the right fit. To know whether it is or not, you need to run an illustration and run the numbers and see if it makes sense. So in my description below, you can schedule a call with me and I can talk to you more about it and make the referral or introduction, or you can go ahead and request an introduction and I'll get that email sent out to you with an introduction to the banks that offer this first lien HELOC, first position HELOC, that you can speak with and you can run the numbers and see if it makes sense for you. Though some of the same banks offer a second lien HELOC, so you can compare it and see if that makes sense. Now, if you don't have good credit, you're not going to qualify. To qualify for a first lien or a second lien HELOC is the same as qualifying for a mortgage. They're looking for a 40% minimum debt to income ratio and at least 700 or better credit. So if you don't have good credit or your debt to income ratio is too high, you're not going to qualify. Okay. And if that's the case, and you need some coaching or support on eliminating debt, freeing up cash flow, and improving your personal credit, again, take advantage of a free consult. We'll discuss how I can assist you and coach you through eliminating debt, freeing up cash flow, and improving your personal credit. If this video is of value to you, please subscribe, please like, and please let someone know who will let someone know about this video and this YouTube channel. Thank you for watching. Take great care and God bless.